Right now, somewhere in America, someone your age is sitting at a kitchen table staring at a Social Security statement, feeling guilty. Because everyone, the magazine article, the guy on the podcast, maybe even their own advisor, told them the same thing. Wait until 70. Just wait. You'll get 8% more every year you hold off. And they're wondering why, deep down, waiting feels wrong for them. Here's what I want you to hear right at the top. Most of the time, that advice is correct. Waiting is a good default, but it is a default, not a law. And for a real minority of people, filing at 62 isn't the mistake everyone assumes. It's the smartest, wealthiest, most secure move on the table. I'm Ryan Parker. I've spent more than 25 years helping people your age make exactly this decision, and I'm going to walk you through the 5 situations where just wait until 70 is flat out wrong for you. Not myths, not loopholes. Real, defensible reasons the industry rarely explains because they're the exceptions, and exceptions don't fit neatly on a bumper sticker. Let me be honest with you before we go one step further, because I want your trust, not just your click. Filing at 62 permanently reduces your monthly benefit. If your full retirement age is 67, claiming at 62 cuts your check by about 30% for the rest of your life. That's the price of admission. So if none of these 5 situations describes you, the honest answer is don't do it. Wait. But if even one of them fits, you may be leaving real money or real peace of mind on the table by following a rule that was never written for you. Stick with me to the end, because reason 5 is the one almost nobody talks about, and it can quietly save you tens of thousands in taxes. And if you want the numbers laid out on paper, I've put together a free claiming age guide. I'll tell you how to grab it in a minute. For now, let's start with the reason that should override everything else. Reason number 1 is your health, and honestly, it's the one the standard advice treats worst. Here's the thing that bothers me. Every wait until 70 calculator you'll find online quietly assumes you're going to live to 90. It just bakes that in. It never once asks you a single question about your health. It doesn't ask about the diagnosis you got last year. It doesn't ask about your family history, the fact that your father and both his brothers were gone before 75. It just runs the math as if you're immortal and hands you the same answer it hands everyone. But Social Security is, at its core, longevity insurance. Delaying only pays off if you live long enough to collect all those bigger checks. If your health is genuinely compromised, or if the men and women in your family simply don't make it to advanced age, then waiting until 70 isn't the safe choice. It's a gamble. And it's a gamble you're likely to lose. Think about it plainly. If you wait from 62 to 70, you give up 8 years of checks, and that's 96 payments you'll never get back, betting that the larger monthly amount will eventually make up the difference. But if you pass in your early or mid-70s, that break-even day never arrives. You collected less. Your money sat with the government instead of in your account. So here's what I want you to do if this is you. Be ruthlessly honest about your actual health and your family longevity. Not what you hope, what's real. Because for someone with a serious condition, claiming at 62 isn't pessimism. It's making sure you actually enjoy the money you earned. Now, this leads directly into a number everyone throws around, but almost nobody explains to you: the break-even age. Reason number 2. The break-even math might genuinely favor you, and you deserve to see it instead of just being told to wait. So let's actually do it together. The break-even age is simply the age at which the total dollars from waiting finally catch up to and pass the total dollars from claiming early. Before that age, the early claimer is ahead. After it, the late claimer pulls ahead. Let me give you clean illustrative numbers. These are hypothetical just to show the mechanics. Say your full benefit at 67 would be $2,000 a month. Claim at 62 and it drops about 30% to roughly $1,400 a month. By waiting from 62 to 67, you'd give up 5 years of those $1,400 checks. That's around $84,000 you chose not to collect. In exchange, you get an extra $600 a month for life. Divide 84,000 by 600, and it takes you about 140 months. Nearly 12 years, just to break even. That puts your break even somewhere around age 78 to 80. Now sit with that. If you claim early, you are ahead. Cash in hand, dollar for dollar, until roughly your late 70s. That's not a small window. That's potentially 15 or 16 years of being the person who's winning. And here's the part the rule of thumb completely ignores. It treats a dollar at 95 exactly like a dollar at 65. It doesn't. The dollar at 65 buys you a trip, a project, time with people while you're healthy enough to enjoy it. The extra dollars that show up in your 90s when you may be far less active, they simply don't carry the same weight in a real life. The math on the calculator says they're equal. Your life says otherwise. I'll concede the obvious. If you're healthy and you live to 90, waiting wins, and it wins big. I'm not going to pretend otherwise, but if your honest expectation lands anywhere south of the break-even, the early check is the mathematically superior choice, and no amount of 8% a year changes that. That handles longevity and math. But there's a completely different reason to claim early that has nothing to do with how long you'll live and everything to do with what the stock market is doing the year you retire. Reason number 3, claiming at 62 can protect your investment portfolio during a down market. This one is subtle, and it's exactly the kind of thing a generic answer will never surface for you. There's a risk in retirement called sequence of returns risk. Let me define it simply. It means the order in which your investment returns show up matters enormously in your early retirement years. If the market drops hard right after you retire and you're forced to sell investments to cover your living expenses, you lock in those losses permanently. You're selling low, and those shares are gone. They can never recover for you because you no longer own them. Now picture the person who says, I'll wait until 70, and in the meantime I'll just pull from my 401k to live on. That sounds disciplined, but imagine that gap falls across a serious market downturn. A 2008, a 2020-style shock. To delay Social Security, they're draining their portfolio at the worst possible moment, selling assets at fire sale prices to buy themselves a bigger check years down the road, claiming at 62 flips that. Your Social Security check becomes a paycheck that lets your investments stay invested, untouched, so they have time to recover when the market rebounds. You're not selling low to fund your delay. You're letting Social Security carry the load while your portfolio heals. I want to be fair here because this isn't a blanket rule. In an up market, or if you've got a big cash cushion to ride out a downturn, this reason matters far less. You could delay and never touch your investments at a bad time. But for someone whose retirement start lines up with a scary market, taking the guaranteed government check early to protect the portfolio can be the wealthier long-term move, even after that 30% haircut. It's about which asset you spend first. And sometimes spending Social Security first is exactly right. That's about protecting your own money. This next one is about unlocking money for other people in your household, and it's the one that surprises people the most. Reason number 4, filing at 62 can trigger benefits for your family that simply don't exist until you file. Here's a rule most people have no idea about. In many cases, your spouse and certain dependents can't collect benefits based on your record until you yourself have filed. Your claim is the key that unlocks the door for them. 2 situations make this powerful. First, the young child. If you're an older parent, and there are more of you than you'd think, with a minor child at home, that child can receive a benefit of up to half of your full benefit amount once you file. So can a dependent grandchild you're raising in certain cases. Second, the spousal benefit. If you have a lower earning or non-working spouse, filing can open the door to spousal benefits on your record. Now, why can this beat waiting? Because those child and family benefits are real dollars flowing into your household every single month between 62 and 70, money you'd forfeit entirely by delaying. In the right family situation, the total of your reduced check plus a child's benefit can far exceed what you'd have collected by proudly waiting alone until 70. But, and this is a real caveat, not a footnote, there are 2 things you must respect. 1, there's a family maximum. Social Security caps the total a single family can draw on one worker's record, usually somewhere between 150 and 180% of the worker's full benefit. So you can't just stack unlimited relatives onto your number. 2, the earnings test. If you claim before your full retirement age and you're still working, Social Security can temporarily withhold part of your benefit if your wages exceed the annual limit, around $23,400 in 2025. So this reason shines brightest when you've actually stopped working and you have qualifying family members at home. Run your specific situation, but if it fits, it can be enormous. Now we come to reason number 5, the one I promised, the one almost no one connects to Social Security at all, and it lives entirely in the tax code. Reason 5, claiming at 62 can fund a bridge to a Roth conversion tax window, and this is where the right household can save real money. Let me set the stage. There's a golden window in a lot of people's retirements. It's the years after you stop working, but before 2 things kick in. Before you claim Social Security, and before required minimum distributions, RMDs, force you to pull taxable money out of your traditional IRA at 73. In that window, your taxable income can be unusually low, sometimes shockingly low, and low income means low tax brackets. Smart planners use that window to do Roth conversions, moving money from a traditional IRA into a Roth IRA, paying tax on it now, at today's low rate, so it grows tax-free forever and never triggers an RMD again. Here's the twist most people miss. Doing those conversions costs money. You owe the tax. So how do you pay your living expenses during those low-income years without either blowing up your income or raiding the very IRA you're trying to shrink? For some households, the answer is you turn on Social Security at 62 to cover your day-to-day living costs. That frees you to convert a big chunk of your IRA to Roth while staying in a low bracket, because your spending is handled by the Social Security check instead of by taxable withdrawals. I'll be straight with you because this is genuinely two-sided. Turning on Social Security adds income, and up to 85% of your benefit can be taxable, which eats into your conversion room. So this is a delicate balance. It does not work for everyone, and it absolutely requires running your actual numbers. But for the household with a large traditional IRA staring down a brutal RMD tax bomb at 73, using an early, modest Social Security check to bankroll aggressive Roth conversions in your 60s can save far more in lifetime taxes than the 30% you gave up by claiming early. That's the whole ballgame for the right person. For everyone else, it's a footnote. Know which one you are. So let's name the real villain in this whole story, because it isn't Social Security and it isn't the government. It's the one-size-fits-all rule. It's the article that says wait until 70, you get 8% a year and stops there, as if you and your neighbor and a stranger 3 states away all have identical health, identical marriages, identical portfolios, identical tax situations. You don't. And that generic answer gets repeated everywhere for a simple reason. It's the safe answer. It's the one the advisor gives because it's the one he'll never get blamed for. Nobody gets fired for saying wait, but nobody looks at your break-even, your family history, your minor child, your IRA, and your down market timing either. There's no commission in sitting down and telling you the truth, which is that your Social Security claiming age is one of the most personal financial decisions you will ever make, and it deserves your actual numbers, not a slogan. So here's your action plan, 5 clear steps. Step 1, be brutally honest about your health and your family longevity. Not your hopes, your reality. This single factor outweighs almost everything else. Step 2, calculate your own break-even age. Take the annual dollars you'd give up by waiting, divide by the extra you'd gain per year, and see where that lands against how long you honestly expect to live. Step 3, look at your retirement timing against the market. If you'd be forced to sell investments in a downturn to fund a delay, an early check may protect your portfolio. Step 4, check for hidden family benefits. A minor child, a dependent you're raising, a lower-earning spouse. Any of these can change the math dramatically once you file. Step 5, map your tax window. If you're sitting on a large traditional IRA and a future RMD problem, talk to a professional about whether an early claim can fund Roth conversions in your low-bracket years. And one more time, because it's that important. For the higher earner in a married couple, delaying usually still wins, because your benefit sets the survivor benefit your spouse inherits, and you rarely want to shrink that permanently. These 5 reasons are the exceptions, Powerful for the right person, wrong for most. Know which you are. If you'd like all of this on paper, the break-even worksheet, the earnings test limits, the questions to ask before you file, grab my free Claiming Age guide. The link's in the description. It's free, there's nothing to buy, and it walks you through your own numbers step by step. Now, I genuinely love to hear from you. Drop a comment and tell me your age and your situation. Are you married or single? Still working or fully retired? And tell me whether you're leaning toward claiming early or waiting. I read these, and your story might be exactly the one someone else needs to see. And here's what's coming next, because it's the natural other half of this conversation. We spent today on the people who should claim early. But if you're married, there's a survivor benefit trap hiding inside the claim early decision that can quietly cut your spouse's income for the rest of their life after you're gone. That's the one couples get wrong most often, and it's the video I want you to watch next. Take care of your numbers. They're worth more than any rule of thumb. I'll see you in the next one. Figures to verify. Current year, approximately 25-30% permanent benefit reduction for claiming at 62 versus FRA of 67. Break-even age estimate, a 78-80. Depends on assumptions. Full retirement age of 67 applies to those born 1960 or later. RMD start age of 73 under Secure 2.0. Up to 85% of Social Security benefits potentially taxable. Spousal child benefit up to 150% of workers' full benefit. Family maximum 150-180% of workers' full benefit. 2025 earnings test annual limit R23,000 form. Illustrative benefit figures $2,000 FRA, each one of $400 at 62 are hypothetical. Approximate word count 2,090 words. Approximate character count 113 through 1,050 characters.